Hey, good morning, everyone. Welcome to this topical workshop webinar. We're going to be talking about market makers. Guys, I'm really excited about this one. This is going to be a special treat for us. We have coming to us from Tradier, Lex Luthringshausen, and I hope I pronounced that correctly, Lex. Lex is the Senior Vice President of Business Development at Tradier, and he actually has experience as a market maker. He's going to tell you more about that in a little bit here, but I'm super excited to have Lex on today. We've never had a market maker on a webinar before, and so we're going to get kind of a different look, really that behind the scenes, behind the curtain look at how that side of the industry runs. So I'm really excited to welcome Lex on and bring him on. So Lex, thank you, sir. Thank you for being on today and for being willing to share with us this type of information that we don't always get to hear about.
Sure. Thank you, David, for the introduction. I appreciate that. So I hope the folks are going to understand what I'm going to say. I'm going to take it easy. So we should get through it.
Awesome. Thank you. Well, feel free to share your screen and just take it away. It's you're good to go.
Okay, sounds good. Let me do that. I'm not working on a laptop here, so I apologize. It's going to be a little clunky, not what I normally like. If there's questions, David, will they come in the chat form?
Some might put them in the chat, but guys, if you've got questions, it'd be better to put them in the Q&A so we can help answer them in the background there. But the chat, feel free to let us know where you're from. You know, we always like to do that. Hi, I'm David from Portland, Oregon. Feel free to let us know where you're from. And the Q&A is going to be a much better place for your questions.
Okay. Can you see my screen?
Looks great. Yep, you got it shared full screen. Looks good.
Okay, perfect. Should I get started?
Absolutely. We're good to go.
All right. I'm going to kind of keep a chat open in the corner. I'm not sure I'm going to be able to look at it in case there's questions, but I do encourage people to ask questions because this is a little bit tricky along the way here. So we're going to try to take it nice and slow. And please feel free to ask questions. Okay. So my name's Lex. And quite frankly, that's not my real name. It's my nickname. My real name is Kevin Luthringhausen. And I grew up in the trading pits of Chicago. Okay. And let me see if I can move this slide because it's not working and I don't know why. Hang on. It should be just a little arrow, I would imagine, but it's not doing it. Okay. Give me a sec. Sorry.
Yeah, no worries at all.
This usually moves. How come it's not moving, David? Any ideas? Oh, I know why. Never mind. Perfect. Okay. Sharing, annotating the whole thing. Okay. So back to who I am. I grew up in Chicago. Okay, and I started in the SIBO in the late 80s, okay, as a market maker. So if you're familiar with market maker, I'm going to use the word dealer and I'm going to use the word market maker. So they're synonymous in terms of this discussion, okay? So think of them that way. Now, what we did is we made two-sided markets, okay? And we had over 350 names that we looked at. So we had Google and EMC, some of the more popular ones, Intel. And what a market maker's job is, and to this day it's still this way, is they're supposed to make liquidity for retail folks and people to trade on. And what I mean by that is they make a two-sided market. That's what they do. And that's what we did. So our business was very large. We competed with the likes of Susquehanna back in the day. I'm sure you've heard of them, and firms like Wolverine. Those firms are still around today. Our GPM pretty large, and we ended up in places like Frankfurt and Amsterdam and London. And we were a professional proprietary trading firm. That's what we did. So I pivoted from that world to the retail world in mid 2015s thereabout. Okay, and we built a platform that was ultimately purchased by Tradier. That's where I work today, and it's a sophisticated options platform. So that's what I did. Is after I went from the pro world, as I moved over to the retail world, and it was eye-opening because the retail world is different. Okay, but what I'm going to touch on today is I'm going to touch on how the dealers or market makers behave. Okay, and these are the people that you trade with. Okay, so every time that there is a trade that takes place, there's someone on the other side of it. And a lot of times we take that for granted as retail folks, right? We say, hey, I'm going to go buy this offer and I'm going to push the button that says buy, and it comes back to me and I get filled, and that's all wonderful. And there's also probably some bit of misunderstanding about market makers too, that they're evil and they're the evil empire and they're out to get you. I would tell you that that's probably not true. They actually don't care about us retail people in terms of how you behave. Okay, so I'll get to that in a second, but let's talk a little bit about how the market makers behave. So what market makers do, as I discussed before or just mentioned, is they provide two-sided markets. Okay, and I hope you can see me annotating here. I'm not sure you can, but I circled two-sided markets.
Yeah, we see it. Looks good.
Okay, perfect. So all that means is they provide a bid and an offer for everything that they trade. Now, let's take Apple, for instance. Okay, everyone knows Apple. I don't know how many strikes there are on Apple, going out from the very beginning to the very end of the expirations, and that includes leaps. There's a particular market maker who's responsible for making markets in every one of those option classes. Now, other market makers can pitch in and offer their markets as well. And what you see on the screen is always what we call the NBBO. Stands for National Best Bid and Offer. Okay, so whatever the best bid is and the best offer is, irrespective of whether a market maker makes that or not, is what's displayed. Okay, and I know I won't get into level 2 and all that stuff, but that's what you see. Okay, and that's what Mr. and Mrs. Market Maker are all about. So they don't have any coffee breaks, and what I mean by that is they're not allowed to leave. They have to have someone present at all times making these marks. Now, in today's world, I will tell you it is 100% electronic. Okay, when I did it, I spent a lot of time on the floor, standing up with my trading jacket on. We had cards, we didn't have computers, we did everything by hand, and we figured everything out on a piece of paper. So that was a lot more difficult because we had to make markets verbally. We stood there and yelled and screamed. There was a quote reporter in the pit who changed the markets as we barked these out. Okay, so think about this concept. If a market making firm, right, has to make two-sided markets all day long, what happens to their, what I call their inventory, their positions? So every time you trade with them, they take the opposite side, right? So they have to manage their inventory, and they behave very different from you and me. Okay, what they do is, let me just get out of my screen share again. Okay, why does this not want to work for me? Sorry, David, I'm having all kinds of issues with my movement here.
That's okay.
Yeah, it worked before. It is not working now. Huh. Okay,
forward.
Yeah, I'm using the arrows on the keyboard and nothing seems to work. It worked before though. Okay, I'm going to stop the annotation. Maybe that'll do something. Ah, bingo. Okay, so what market makers end up doing is they end up with inventory. Okay, and it's not inventory they necessarily want. They, by virtue, have to make these two-sided markets. So they have to understand the Greeks very well. And I will tell you that the market making community doesn't just look at deltas, gamma, theta, some of the ones you're familiar with, and vega and rho, although they do. They have a measure of all that in every one of their positions. Okay, there's sub-Greeks that are called things like Vanna and charm, and I'll talk a little bit about those in a while. But Vanna and charm are what we call second-order sub-Greeks, okay, or sub-Greeks, I should say. Okay, and they tell you how your inventory behaves with respect to implied volatility in one case, and with respect to the passage of time. Okay, so we'll get to it in a second. But think about it. Market makes this gigantic, just canvas of positions everywhere. Okay, and I will tell you that the market maker doesn't want to have any risk exposure. Okay, the firm as a market maker takes delta out of the equation. So if you think about it, they don't have a bias on which way the stock is going. Okay, so when I traded in the pit, I was a DPM. You know, we had, like I said, we had a ton of products, and let's pretend I traded. You know, we traded DoubleClick a long time ago. I don't know if any of you remember DoubleClick. I'm not sure it's around anymore. But I can tell you that I have utterly zero idea what DoubleClick does. I didn't even know what the stock did. I didn't care because our edge was built differently. Our edge is built in the bid and ask, and we're going to talk about that in a second. But but all of these positions that these market makers have, they're interacting with all of these all day long, 6.5 hours a day. There's 15 different exchanges. There's over 4,000 classes of options. There's probably only, to my estimation, probably only 7 to 9 true market making firms left in the industry. So it's a small group of people who are left, who are taking the other side of your position. In 2022, 10.38 billion option contracts traded. Market makers interact with, the stats I've read, somewhere in the 90% range is what they interact with. So think about the size of their positions, right? And as I just mentioned, they have no interest in having inventory and having risk exposure. So whenever they get deltas, they hedge them. Whenever they get too much gamma, they hedge it. Whenever they get too much vega, they hedge it. They try to get things down to zero or near zero as best as possible. So market makers are buying bids, selling offers, and hedging in between. Okay, so it's important to understand that with their exposure. They eliminate delta as a Greek almost every second of the day. Okay, so when you, as a retail trader, buy a call, a market maker sells a call. So remember, when he or she sells a call, he's getting short deltas in that example. Calls have positive delta when they sell one, it makes them short. Remember what I said. They do not want to be short. So they go and purchase stock, park their deltas in stock so that they're delta neutral. Okay, we're going to see an example in a second, right? The opposite occurs when market makers buy calls. When you sell a call to a market maker, they buy it, they get long deltas, they hedge it by selling stock. Okay, now clearly they're not just using stock all the time. Stock to a market maker, okay, especially back in our day, is a worthless hedging tool. It has no value to them other than the fact that they're parking their deltas in it. Okay, so unlike us, like we retail traders, right? We have a horizon and a directional bias mostly. Okay, we think Apple's going to go up, so we do a call, we sell a put spread, we buy a call spread, whatever, right? So any of those sort of things. Market makers don't think that way. Okay, they don't do spreads that are called iron condors or butterflies. They don't do those naturally. They do them by legging into things and using synthetics. And we'll see what a synthetic is in a second. Okay, David, I'm not looking at questions. I see some chats going by. Should I be looking at those to answer anything or no?
Oh, no, you can keep going for now. I'll sift through those at the end and see if there's any questions to bring towards you.
Perfect. Okay. And the opposite is true with puts, right? Trader, investor buys a put, market maker sells it. Puts have negative deltas, right? So when you sell a negative delta, you're going to get long. So the market maker is getting long in that example, and therefore has to sell some stock to flatten his deltas out. Okay. So think about this relative to the last slide. They're doing this 10.38 billion times, a year, right? They're always doing this. Now, in today's world with electronics and very few market makers out there, I was talking to some Susquehanna folks at one of the conferences recently. The hedging mechanism has probably changed a little bit for the market making community of today. They probably hedge a little bit less, and they may even hedge on time limits, like 10 o'clock in the morning and then again at 2. So I think they trade so much now because there's so few of them that they're able to gain edge by every trade that they make, so that they don't have to hedge with stock as much. Stock costs money to them, right? So they have to pay commissions when they trade stock. Okay, so they probably don't hedge as much as we did. We did it all the time. Back in the day when I was working as a market maker in our firm, I walked into a competitor's office, and this was on their whiteboard, the dealer edge. Okay, and the dealer's mantra, again, dealers is a market maker. There's no edge without the H. I saw it written on the whiteboard. I said to the owner of the company, I said, what does that mean? I don't get it. So what he said to me, he goes, think about it. The H plus edge is hedge. So you can't have edge unless you add the H to it. And in our world, we taught hedging. Okay. So I thought about it. I said, that's fantastic. I love it. So to us, right, as market makers, let me draw again. I'm probably going to mess me up, but I'm going to try it anyway. Hang on, let me get these. Okay, so remember, market makers are constantly posting two-sided markets all the time. I'm just going to give you one simple example. This is an XYZ 50 call. Okay, they post a $1 bid and they post a $1.50 offer. And again, I made these prices up just to make it very simple, the mathematics. Okay, I made it a 40 delta, right? We know it can be anything, but this is a call. I put theoretical value right in the middle, okay, for a reason. Makes it easy again. So what Mr. and Mrs. Market Maker do is they pay $1 and they sell them at $1.50. And they would do this a million times. This comes back to my original comment about they don't care to disenfranchise you retail traders. They don't care to cheat you. They're not trying to steal from you. They want you to trade on this market as many times as you possibly can imagine you can do it, because their value is 125. Every time they sell something for 150 in this example and hedge it, they're going to realize that 50-cent edge. Something that's worth 125, if you're selling it for 150, you've got 25 cents edge. Conversely, if you're buying something for $1 and it's worth 125, you have 25 cents edge on the buy side. Now, it's not that simple, right? Because if you just buy and sell this, you don't have a hedge on. If the stock moves adversely to what you have on, you're going to give that edge up. Therefore, the market maker parks his deltas in that stock position so that when he does this trade in time, he can hedge it with stock right at the moment and sort of lock that edge up. Now, look, I say lock it up, right? It's not always a lockup because things can move dramatically. You can have bad gamma, you can have bad everything as a market maker. So you're given the position. You're not going out proactively and creating it. So you could be giving some bad stuff, a lot of shorts. You got a lot of negative gamma. You get big price movements that we've had in the recent past with this implied volatility and big market moves. You're going to get negative gamma, and you're going to have bad positions that you have to manage. And you're going to continually update and manage that delta as the stock moves. But this is their best estimate at how they can accumulate edge. Now, remember, they're doing this little 25-cent exercise all day long, every single day of the year, as many times as possible. They want you to make this trade with them as much as you possibly can stand, because again, they're accumulating this edge, right? Now, as a retail trader, you don't have this edge. You don't. Your life doesn't live in here. You have to pay near 150 to buy this call, and you have to sell near $1, okay, to sell that call. Now, some people have said, well, sometimes I put a bid out there and I'm matching with the market maker and I get filled there. So that's good, but remember when you're matching the market maker's bid and you get filled there, market maker's no longer one bid anymore. It's probably more like a $1 offer. That's why you're getting filled or thereabouts. So keep that in mind. You're not moving your markets like these people are. Their machines are built so that these constantly update these markets, and it's all electronic now. They constantly update around theoretical value. The theoretical values are pumped in with high duty algorithms and lots of mathematics, and it's moved based on their inventory. If they start getting too long in something, they shift everything so that their prices change. They're doing this all day long, and it's done by a computer now. It's amazing. And we're talking like billions of dollars now what these market maker firms use so that they don't get into bad inventory. Okay. David, all this makes sense so far? Am I making any sense at all?
Yes, it's sounding good.
Okay. So remember, here's their edge. Okay, let me try to change the slide. I know how. Okay. Now remember, I'm not going to go through all this. This is also very heady, but market makers don't want to have exposure. They don't want to have Greek exposure, Vega, Gamma, especially. They'll take a little bit. Certainly don't want to have Rho. Okay. So what they do is they trade synthetics. What is a synthetic and why is it important? All a synthetic is it's a combination of two or more options with either stock or other options to make the actual asset. Okay, I'm going to explain one or two of these. And why is it important to the market maker? Because it helps them hedge their Greek options inventory. So if they're always getting hit buying a certain call, let's take that 50 call, they're always buying it, they're getting filled up with it. I don't want to buy any more of these. Well, they can take that 50 call and make it into a put. Okay, so a synthetic, if they're long the call, they want to sell the synthetic call essentially, right? Or even they can lock it up with a put. So a synthetic long put in the first line there is a long call plus short stock. in a 1-to-1 ratio. So if I buy one call and sell 100 shares of stock, okay, whatever that call is that I bought, let's make it the 50 again. That's equivalent to being long the 50 put. Okay, so if I buy the synthetic package, and I'm making the numbers up, for $1.50, that synthetic put, okay, is $1.50. The real put better be trading darn close to $1.50, or there's what we call an arbitrage. Okay, so an arbitrage means that they can buy that call, sell that stock, and let's say the combination of what that comes out to be is 150. I'm not going to go through the math right now. And then they look and see the calls, the actual put is 175 bid. They're like, wait, I just did this for 150. If the real put's 175 and I sell it and sell the remaining stock, I lock in another quarter, another 25 cents, right? Now, I will tell you that doesn't happen, right? Why doesn't it happen? Because these billion-dollar computers I told you about, they're constantly keeping these markets in line so that arbitrage never exists for the most part. They might get it by buying their bid and selling their offer, and they're making those quarters, but it's not available for you and me in the retail world. It's just not, okay? You're not fast enough. You're not buying bids and selling offers like they are. They can do this. So they'll shift their markets around with all these synthetics so that their inventory ultimately looks like what we call a box. In a box, all a box is it's each line is hedged up. Long call, short put, long put, short call. It's kind of boring, quite frankly. Okay, they're trying to get into these positions that have no Greek exposure, and they're trying to lock them up for a good money profit. Right? Remember our edge discussion a few slides ago. Every time they make that edge, if they can lock that up with synthetics, okay, it eliminates the exposure. So movement in the underlying doesn't have to behave that way. Okay, this will all make sense in a second. Don't worry. Okay, so I'm not going to go through that box because that's complicated in pricing all these things. Unless someone has a question about it, I can do it later. But that's how they look at this whole thing. Now, don't forget, they have time. So expirations come one right after the other. So if they're buying options out in Jan of 2026, they're not necessarily trying to sell things in Jan of 2023 or near dated options. That time frame is too great. So we always had a saying in our trading firm when we taught all of our traders, and we had a university built in. We told them that think of a hedge as a concentric circle. Okay, you know what that is? You got a little circle in the middle, and there's circles going around it and getting bigger and bigger out. The best possible hedge. Who knows what the best possible hedge? If I buy the 50 call for $1, what's the best possible hedge? Most people say, I don't know, something right around the 55 call or maybe the 45 call or thereabouts. I say that's good, but it's not the best hedge. The best hedge is taking that $1 call that you purchased, the 50 call, and selling it for $1.50, okay, or $1.25 for that matter, for fair value, right? That's the best hedge. Why? Because it puts money into your bank. You've made it 25 cents in my example, or 50 if you sold the offer. It takes the inventory out of risk and out of your portfolio. It goes away. So that concentric circle is the very, very nucleus of your trade. So you can buy that and sell it back out. Wonderful. Doesn't happen very often. And as you go out in concentric circles, the next best hedge is doing that synthetic, selling the put, selling stock. Now you bundle that call up into what we call a reversal, takes the risk exposure out, sits on your sheets, you have to margin it, but it takes out the risk exposure. And as you go out in time and away from that strike that you traded, the concentric circles get bigger. So market makers look to kind of keep everything contained around that center concentric circle as best as possible. So they're not making trades out 3 years from now and hedging them with near dated options. They want to hedge those far dated options with far dated related options if they can. Okay, so keep that in mind about how these people behave. Okay, and remember, they're accumulating inventory, right? It's very important to realize that. So maybe a lot of you weren't around back in '87. That was our first real modern day crash with options involved. Options were around. So I don't know if you've heard of something called skew in options. Okay, now what skew is within an expiration, it's the relationship of out of the money puts to out of the money calls. Okay, now back when I first started in the late '80s, there was no skew like it's drawn here. So let me take my little drawing tool here. So as you can see, This is the skew curve right here. And here's, you know, I would kind of thumbnailed the at the money in this particular example. So these are out of the money puts on this part of the curve, and over here are out of the money calls. And what skew is a definition of, or a relationship of, is they typically look at the 25 delta put in relation to the 25 delta call. And what happened after 87, because of the velocity of this move back then, it was very scary. People were terrified. It wasn't a big dollar move. I think it was like 500 points, but you know, the Dow was probably a couple thousand or something like that. So it was percentage-wise very large. The skew, the relationship of puts and calls back then didn't exist like this. It was a smile. So think of it like this, a perfect smile like that. So calls and puts were fairly valued implied volatility wise, okay? And to some degree, because the market only went up back then, calls were higher implied volatility because people just kept buying them and market makers moved them up. Once this 87 crash happened, we had the introduction of what we call skew. So market makers got smart. They said, if you're going to want to buy puts from me, you're going to pay up for them. So I'm going to raise up the implied volatility, which raises up the value, which raises up the markets. And therefore you've got this funny looking skew kind of thing where the 25 delta put might be I'm making this up, but a 30 delta, I'm sorry, 30 IV. And the 25 delta call in the same expiration might be a 25 implied volatility, right? So they're 5 volatility points apart. That's a 5 skew in common terms, okay? That's how we refer to that. So the market makers smartened up. They said, hey, you portfolio managers who are buying puts from me and selling calls to me to hedge those puts, I'm going to make you pay up for it. And that's how this came about, okay, after that 87 crash. So if you look at any skew curve, you'll see this relationship. The only time I've seen it inverted, where the calls are higher in recent memory, is during the GME GameStop extravaganza. So there was so much buying of upside calls, and that move, those moves were gigantic. It just became crazy. You know, the purchasing. So the market makers just tilted that skew up. So I've seen that once in modern times. Okay, so that's how the skew came about from 1987. Okay, now gamma, Vanna, charm. Okay, I'm gonna go a little bit slow. Gamma is how your deltas move with respect to the underlying. Okay, so if I'm positive gamma, I get longer as the stock goes up. I get shorter as the stock goes down. Now remember, the market maker has positions. If the market maker has a position that's long gamma and the stock's moving up and they're getting longer and longer deltas, what is the market maker going to do? He's going to sell stock because he wants to be delta neutral. He doesn't want those deltas. If the stock's going down, the market maker is getting shorter and shorter. At some point, the market maker say, that's enough. I'm going to buy deltas to hedge my move and hedge my deltas. Long gamma, it's a position of power for a market maker because they can sell into up moves, they can buy into down moves, right? Covers their deltas beautifully. Opposite, negative gamma, it's the opposite. When the stock goes up, they get shorter. They have to buy a little stock to hedge that delta position. When the stock goes down, they get longer. That's not good. They got to sell stock to hedge that gamma position. Okay, so again, market making firms are doing this, you know, in minutia bits all day long. Now, as I said earlier, some market making firms probably hold off on that a little bit more, but by the end of the day, they're starting to peel out of those deltas, okay, and get it back to flat every day. Okay, now let me see the next slide here. Okay, so I just explained that what gamma is on that. Let me go back one actually. I want to talk about Vanna and charm. Now, what Vanna is it's the sensitivity of your delta position with respect to implied volatility moves. Okay, now let's think about this. Let's talk about out of the money puts and out of the money calls. Puts have negative delta, calls have positive delta. Okay, so if implied volatility is going down, okay, it's going from a higher number to a lower number. What happens to out of the money puts? Okay, so what happens is that those puts tend toward zero delta. So the delta of that position is getting lower as implied volatility goes down, right? So if they're tending towards zero and implied volatility is going down, they're tending towards zero. So if I sold a put that has 40 deltas, okay, and implied volatility goes down, guess what happens? that delta goes from 40 to 30, let's say. Well, if I have a hedge position at 40 deltas, and now it's only 30 deltas, I got to do something about my hedge, right? Applied volatility change, and the market maker says, wait a minute, I'm not as long as I once was. I went from 40 deltas, short delta, short put, to 30. I better sell some of my stock. So that Vanna is a very, very powerful feature that probably no one's heard of, that market makers pay attention to. Now, again, we didn't have this term back in the late 80s, early 90s. We knew it intuitively that implied volatility had the effect on your out of the money options that way, but we didn't call it Vanna then. Some genius mathematician came up with this and called it a name, and so it stuck. Conversely, or the same charm. So charm is the sensitivity of your deltas to the passage of time. Again, let's look at the out of the monies, calls and puts. As time goes by, where do out of the money deltas go? They're tending towards zero, because if those options are going to expire out of the money, they're going to expire worthless, and they're going to have zero delta, right? Conversely, in the money options that are going to are heading toward expiration, they've got to go to 100, because you're going to get assigned, or if you're long them, you're going to exercise them and it'll turn into stock. So they're going to 100 deltas. So charm has those opposite effects. Okay. Now, here's where we can take a little advantage of the dealer. Okay, so there's this graph right here is a gamma exposure graph. Okay, and we have this in one of our platforms that we show this. I typed in, I think I typed in spiders here, if I'm not mistaken. I got so much stuff in front of the computer. Yeah, so this is a little while ago, but this is very typical. Okay, this is a very typical gamma exposure graph for a dealer. Okay, this is what the dealers have. Now, this graph here is showing downside negative gamma for the dealers. Okay, it's showing upside positive gamma for the dealers. Okay, why? Who cares? What's the big deal? This is where you have some edge, because you don't have it buying the offer and selling the bid. That's the dealer's edge, remember. Okay, so what dealers have to do down here with negative gamma, when their stock runs to when the spiders run down to where those shorts are, and it looks like about the 390 in this example down here, roughly is a big negative gamma, they're getting longer. They're short puts, they're negative gamma. As the stock goes down, they get longer. They don't like getting longer when the stock goes down. They have to sell more stock. So what tends to happen in negative gamma zones, okay, like this one, is you bounce around that negative gamma as long as it's behaving, the underlying is behaving. And what I mean by behaving is that it's not violently running through. If it's violently running through, it's going to get pushed even further, right? Because the dealer's getting longer and longer. He's going to keep selling stock. That's going to accelerate and exacerbate the problem, right? So think about it. In these negative gamma zones, dealers are a little squirrely, I'd say. They have to hedge things when it goes against them, and they're going to move this market a little greater. So what I like to tell folks is, if you have the ability to have the opposite position of a dealer down in these zones, you're probably very better off, because you're going to have higher volatility, implied volatility moves and intraday moves around these negative gammas, especially when they break through. Okay, so when it goes to 380, 370, dealers are saying, uh-oh, I'm getting long, start selling. What does that do? Boom, 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 keep pushing that stock down. Okay, so when you see these negative gamma zones, you can expect that if the stock's not going to behave, dealers are going to make it move faster. If it's going to behave, dealers will love it. They're not doing anything. They're letting it sit here and letting things decay. Conversely, to the upside in gamma zones, right? Same problem. Opposite behavior. When dealers are long gamma, it runs through those zones. They're getting longer. They're selling stock. So a lot of people have heard strike pinning. So what happens in strike pinning is that the dealers have these big long gamma positions. And every time it runs up above the strike, the gamma kicks in, they sell stock, it knocks it back down to the strike. Every time it runs underneath the strike, they buy more, it pushes it back up. So tends to be a magnet of sorts around long gamma zones. So you don't want to be with them there. They're going to pound the stock when it goes above, and they're going to buy it when it goes below, and they're going to tend to pin it as they can. Now, this graph, incidentally, I think I punched in maybe 3 months of gamma exposure. So I took the first few expirations and came up with this graph. Now, you can pick anything, you can go all the way out in time. One note is the Vanna gamma charm exposure tends to be more profound in the earlier months. So I tend to look at it, with closer up kind of inventory. So we have an algorithm that produces these sort of things. Okay, so think of it again real quick before I switch. Negative gamma zones down in here, higher volatility for the stock potentially, less volatility to the upside. Okay, David, everything making sense a little bit, I hope?
Yeah, that's great. Thank you, Lex.
Okay, just checking in, making sure we're all not, we'll probably sound asleep here, but we'll get through.
No, you're good.
All right, so let's see, the next one, Vanna exposure. Okay, so different effect here, right? Remember I talked about the short, we're still short puts on the downside, Mr. Dealer, Mr. and Mrs. Dealer here. They have long Vanna on this one because what happens to them is when they're short this put and the implied volatility goes higher, right? What's going to happen is that puts are going to tend toward 50 deltas. So they're going to push those deltas up a little bit. With higher volatility, there's a better chance that they come at the money and then in the money. So those deltas go up. So what happens to the dealer in short put positions when volatility goes up, right, is their deltas get longer. They go from 40 delta, and again, I'm making that number up. If implied goes up, it can go up to 50 delta. So if they're short that 40 put, at 40 delta, and now it goes to 50, they've gained more deltas. So 50 delta that they're short, they've got to sell more stock against that as volatility moves. So I like to see this. These are always going to go hand in hand. So whatever gamma is, it's going to have a defined example of Vanna. Okay. And the same thing happens on out of the money calls for dealers. They're typically long these, not always, but typically long these. As implied volatility goes up, that delta goes up for that out of the money call. Dealers get longer. So when they get longer, they have to sell stock again. Okay. That's what tends to happen. So this phenomenon can occur as implied volatility is moving, and the dealers are adjusting their positions based on that movement with this suborder Greek. Okay. Other thing, charm, same deal. Okay, different result. Notice it's negative charm for these dealers now. So as time goes by, they're less long. Okay, deltas are decaying towards zero from a 40 delta short that they're short. So if deltas are going on, that puts still on the money as time's going by. That delta's tending towards zero. We're losing those long deltas, getting shorter and shorter and shorter. We got to start buying stock in with charm. Okay, out of the money calls, same deal. If they're long those out of the money calls, as they mostly are, as volatility, as time's going by, that delta's tending towards zero. So that long delta might be at 25, goes to 20. As time goes by, it goes to 15, 10. They're not as long as they think they are as time goes by. So what we used to do on Fridays, because once Friday ends, there's no trading on Saturday and Sunday in options, right? So the way we figured charm in for options in our positions is we just moved the data ahead on our machines. We figured out what our delta was on Friday and what it was going to be on Monday with no movement in the stock, right? And then once as the day drew on and got near expiration, we would start using Monday state and start hedging our positions based on Monday state. That's just charm. That's all that is. We didn't know it as that then. We just intuitively knew that happened every Friday. So we just moved the data ahead. Now, one of the things that to know here, oops, sorry. I gave an example of this GME, this GameStop. Now, I know this happened a long time ago, but the opposite effect happened here. So the dealers got short a lot of out of the money calls. You can see this little gamma exposure graph down here. This is a while ago, I get it. But right about here, okay, and this is very rare, but right down in here is the negative gamma that they had in GameStop, okay, GME. Now you remember what happened. It was insane move up, insane. Retail public kept buying calls. Someone's on the other side. We learned today that that's the dealer. They're making markets. They can't run and hide. They can't go to Starbucks. They've got to be there. So they keep selling these things. And what are they doing? Buying stock, selling calls, buying stock. Now they're hopefully trying to wean out of some of that stock into another option, but that doesn't happen when paper's one way for them. So they've got to use stock to hedge their deltas. So what's the effect, right? Just an onslaught of call buying, dealers selling, buying stock. It accelerated itself. Okay, and all it did was it put fuel on the fire. So as people kept buying more and more calls, dealers kept buying more and more stock. What does that do? Pushes the stock up, drives it up. Now you'd be surprised the size of dealer inventory and what little amount of notional deltas it takes to move stocks like this. As we learned in GME, I don't remember the exact notional value of deltas they were hedging, but it was hundreds of millions of deltas. You can imagine a stock like GME, it's not nearly as liquid as spiders are, QQQs are, right, or SPX, how profound the moves can be. And we saw that. We had $100 moves in this underline. It was a combination of more call buying, dealers hedging, dealers hedging, dealers hedging, right? It just drove the stock like crazy up. Now, at some point, the hedging runs out, right? There's no more short gamma to the upside. Dealers don't have anything to do up there. They hedge everything that's run from their shorts now. They're deep in the money. So the hedge runs out. There has to be a new position sort of exposed when that happens. And it does that too in the spiders. I always like to look at spiders for dealers' positions. When it gets beyond those zones, it's got to go to a new level. There's got to be a re-hedge by the investing public for them to establish these gamma zones so that we can take advantage of that stuff. Okay, I hope that kind of made sense, David. I'm happy to answer some questions. One of the things that I'd like to say too is that we have a YouTube show that we do, and it's called Options Brew TV. I host it. We bring in guests and we talk about this kind of stuff. Now I know this is probably a little bit more advanced topic. I get it. But it's interesting kind of stuff. When we talk about these topics on Options Brew TV, so if you feel like subscribing, great. We do a live show every Thursday, and then I interview various guests from time to time, and we tape those. But the live's 7:45 Central on Thursdays, most Thursdays, right? But anyway, it's fun kind of stuff, and we have a whole library of maybe probably 200 videos on these types of activities if you're interested in that. Okay. So that's it, David. I think I'm done.
That's great, Lex. Thank you so much. That was incredible. And I think many of us are still pretty familiar with that whole GameStop run, right? So it's kind of cool to see that behind the scenes look of what was going on there. Because that was, there were some crazy moves in there. One day the stock was over $700 and that later on that day went below $100. So crazy things. And one thing that also stuck out to me is when you were talking about the market makers pinning a certain strike price and or a certain stock price, but they're using options and everything. We actually have a course called Sharpshooter where we look at some of those things going on. And so guys, if you want more information on that course and how you can use some of those things to your advantage, feel free to reach out to support. Well, Lex, we've got a few people that have questions in here. If I can fire a few questions at you.
Sure.
Chris is asking, does the NNBO have to come from the same market maker, or can one price come from a market maker and the other price from a different market maker?
Sure. Yeah. So that's a good question. The answer is it can come from different market makers. So the DPM. And what a DPM is a designated primary market maker. It's a SIBO term that was adopted in the industry. It's like a specialist, okay? So they assign those to folks, and our firm became one of those people. And their responsibility is to provide a two-sided continuous market. So if everyone goes to the Starbucks, they still have to be there, right? But everyone is entitled to post a market. All the market makers are. And if there's a market maker from XYZ decides to put a better offer up than ABC's offer, then that new offer is going to be the new NBBO. So it can come from different players in the market, right? So what we always did is we had theoretical values, and we made our markets around theoretical value. And it was all different, right? But let's say it's a dime around theoretical. So as theoretical changed, our markets just changed, and we kept that theoretical value in the middle and about a dime on the bid, dime on the offer. We just kept moving them the whole time. And if someone wanted to get in between us, so be it. Now, I think there's rules that you can't improve a market as a retail person with a one lot. I think there's got to be a certain size before they'll show that. And I'm just not familiar with the new rules. It's changed a lot. But if you put a better bid up, they might not show your bid if it's not bigger than like a 10 lot. I can't remember the exact number now. So.
Gotcha. Yeah, that's awesome. Hey, we got another question from John. He's asking, in the current market volatility, what are the odds of entering or exiting a four-legged spread at the mid price, assuming that it's a liquid stock?
Yeah, these are great questions. So liquidity has to be your friend as a retail trader, okay, first of all. So if you're trading super wide products, you're going to give up your edge, even if you're right, in wide markets. So you got to be careful there. I'd say you look at, again, remember the market maker's behavior and model. It's edge. So they don't want to do things at midpoint because there's no edge there. So midpoint is roughly about theoretical value most of the time. It's not always that way, but most of the time. So a market maker has to generate edge. So they're not going to give you much zero edge. Now, sometimes they will do it. And why will they do it? Because the position fits their inventory to a point where it takes risk off for them. So they might get out of risk and get out of things that they have for fair value. So that is absolutely possible. What are the odds of it? Not high.
Gotcha.
So not very high. Yep.
Yeah. Great. Ron's got an interesting question here. Will AI eventually replace market makers?
That's a good question. Well, I think you'd be surprised. I think market makers were the first AI people ever. So what they do is AI. It's essentially that. So it's gotten so sophisticated how these people post markets now, and it's almost like artificial intelligence in a way, right? Because they're looking at their entire book of inventory. They've got SPX, they've got all kinds, they've got bonds, they've got, you name it, they have it in this inventory. And everything is a massive hedge, right? So these guys are just doing things. They don't want interest rate exposure. They don't want vega exposure. This is all their systems that are telling them these things and making real-time decisions automatically all day long, all day. So is that AI? Kind of. I think it is, very sophisticated nowadays.
Yeah. Yeah. Fantastic. Hey, we got a couple students that are asking for the title of that YouTube channel again, and when it plays.
Sure. So Options Brew TV, like options like brew as in coffee brew, Options Brew TV. If you search Options Brew TV by Tradier, it's there. And we had some summits. David, you were at our last summit. Those summits are posted there as well. We have interviews with really interesting sort of people who have, educators and platforms and just people in the industry are there as well. The live show is most Thursdays at 7:45 a.m. Central Time. Okay, and I have two other people who join me. One is I always call it to his face. He's a mathematical brainiac genius. He created a gamma exposure system that's awesome. It's called vol.land, and we talk about. He always gives us the new levels. So it's really interesting, and you get new levels for free. We just come on Thursdays and watch it. We'll talk about the new levels in SPX where they exist, and there's interesting stuff around that. And then the other gentleman is a former market maker, one of my competitors back in the day, who's now managing some money, and he has some really interesting takes on how he manages assets, which is kind of cool. Yep.
Awesome. One question that I thought of, wanted to throw out to you, and maybe it'd be hard to answer this one, but I figured I'd give it a try anyway. What are things that many of us retail traders, what are some things that we should be doing to be more successful from your point of view? Maybe what are common mistakes you saw as a market maker? Like, oh man, if they would just do this or that, they would be more successful in the long run.
Yeah, it's a great question. So here's what I would say to that. The biggest hurdle for a retail trader, right, is trade idea generation, right? So remember what I did is for a living. I didn't have any reason to do an iron condor or a butterfly. It didn't exist. All I did was I was responsive to the markets as a market maker. So I didn't care about direction or anything. I just cared that people sold my bid and bought my offer all day long, right? Now, in today's world, as a retail trader, I find it very difficult to be super successful because I'm not very good at picking out direction. It wasn't part of my DNA and what I was taught, right? But retail people are very good at it. So what I would say to answer that question is really study your stocks well. If you have an opinion, wonderful. Have a great opinion on the direction. Take advantage of it, but make sure there's liquidity and there's really tight liquidity in the products you're trading, okay? Because you're going to get eaten up to death in illiquid, non-trading kind of things. So be very careful. Now, am I telling you to trade spiders? Not necessarily, okay? Spiders are penny wide, so that's a pick 'em sort of market. It's okay. But if you have an idea of direction on the market at large, Why wouldn't you trade spiders or SPX? Markets are fairly tight. You can get in and out without any pain. Okay, so that's number one. Number two, people aren't going to like me saying this, I don't think, but you have to learn how to effectively and safely sell options. Okay, now people are like, what do you mean? We as market makers had a bias of selling premium. Okay, we were like insurance salesmen. We sold options. We gave the right away to other people, but don't forget what options are. They're decaying assets. Okay, they decay day in and day out. No, not always true. You get big moves, you get killed, right? But that's when all these iron condors came into existence, butterflies. If you're able to effectively sell good, high value, high volatility options safely, it's a great way to make money. You can do things where you don't have to think about direction so much. You can let time work its magic on you, and you have to be very diligent and disciplined about hedging and taking losses where you're supposed to take losses and letting those gains run. I know it's harder said than done, but you have to think about it that way too. I didn't really start making really great money until I learned how to sell options, I would say. Those two things, super important.
Wow, that's really, really good practical information, guys. Two things I heard from that: liquidity, that's a huge one, right?
Huge.
And the second thing, a big edge is selling options, right?
Yep.
So,
Safely.
Yeah, absolutely.
Yeah. I have many stories about not safely selling options that really hurt. It wasn't fun. I lost a lot of money. It taught me valuable lessons that, you just get back on the horse and you keep moving.
Absolutely. Well, Lex, the last question I'm going to throw at you here is, Gordon's asking, are all the trades that Tradier do they go through the Apex clearing?
Yes, they do. So Apex is our clearing agent and our custodian. So all money is custodied at Apex. Individually, it's obviously separated out at Tradier, so you have your own account, all that kind of good stuff. So yeah, all trades are gone through them, and the way it works with options and stock for that matter is it goes through a managed route. So when you hit a send button or a buy button or a sell button at Tradier, it goes to the pipes at Apex, and it goes to auction to the market making community. Now they don't pick a particular market maker to send it to, like Citadel or Susquehanna or Wolverine. It goes to the community. They make their best bids and offers on that stuff. They improve, price improvement as well, and then they trade it, comes back seamlessly, and fills your position. So that's how it works. Yep. Some brokerages will directly route to certain people. I think Robinhood does. I think they deal with Citadel a lot, but we don't do that. We just send it through and it goes to wherever it can be filled best.
Awesome. Well, Lex, thank you so much for being on today.
Sure.
Guys, I hope this was fun and interesting, a little bit different as well. And guys, as you can see, Tradier, the brokerage firm that we recommend, they've got some heavy hitters behind there, right? Got some guys from all over the industry who really know some stuff, right? So this has been a really good one. Guys, if you don't have a Tradier account yet, I just dropped a link in the chat there. Feel free to click that link and it'll bring you right to the site you need to open up a Tradier account. So we're thankful that we have people like Lex working there who really have a lot of industry knowledge and experience because it really just increases the value of the firm altogether. So Lex, thank you so much for being on again. This was a lot of fun. I'd love to do something like this again in the future as well. And sure. Guys, thank you all for being on as well. This is really a good one.
Thanks, David. I really enjoyed it. Really great questions and really fun. Hope to meet everyone in person one day. We'll do one of these live sometime.
Oh, that would be fantastic. That would be fantastic.
Good.
All right, guys. Have a great rest of your day, and we'll see you on the next one.
All right. Thanks, David. Bye now.